There's this moment that happens usually on some random Tuesday morning when you check your investment account, and the number staring back at you has 7 digits 1 million and some change. Maybe it's been building toward this for years, maybe you've been watching it creep closer month by month, but seeing it actually there, officially past that threshold, does something strange to your nervous system. It doesn't feel like confetti and champagne, it feels quieter than that. More like the moment when a plane reaches cruising altitude and the seatbelt sign turns off. You're still moving, but differently now. The turbulence of takeoff is behind you. What lies ahead is something else entirely. My name's Anderson, and I've spent years studying not just how people build wealth, but what happens psychologically when they cross specific financial thresholds. And what I've discovered is this: $1 million invested isn't just 10 times better than 100,000. It's categorically different. It unlocks a version of financial reality that operates under completely different rules than what most people experience their entire lives. And if you don't understand what changes at this level, if you don't know what to protect and what to avoid, you can reach this milestone and still make mistakes that cost you years of progress. Let me show you what actually shifts when you cross into 7 figures, and more importantly, how to navigate it without destroying what you've built. Here's what most people believe about wealth. They think it scales linearly, that having 200,000 is twice as good as having 100,000. That a million is simply 5 times better than 200,000. More of the same, just bigger numbers. But that's not how money works once you reach critical mass. Wealth doesn't grow in a straight line, it compounds exponentially, and there are specific inflection points, specific dollar amounts, where the fundamental nature of money changes, where you stop being someone who owns some investments and become someone whose capital generates meaningful power. $1 million is the first place where most people experience this transformation, not because it's some magic number, not because it makes you rich in any absolute sense, but because it's the threshold where invested capital starts producing income that rivals what most people earn through labor. Let me show you what I mean mathematically, because the numbers here are striking. If you have 20,000 invested earning 7% annually, that generates about $1,400 per year. Helpful, but it doesn't change your life. You're still entirely dependent on your paycheck for survival. 50,000 invested generates roughly 3,500 annually. Better, but still supplemental. Still not enough to fund any meaningful portion of your existence. 100,000 generates about 7,000 per year. Now we're talking about something that could cover certain expenses, maybe your rent or your car payments and insurance. But you're nowhere close to independence. But $1 million? $1 million invested at that same 7% return generates $70,000 annually without you working, without you commuting, without you answering emails or attending meetings or dealing with any of the friction that comes with trading time for money. $70,000 is more than the median household income in most American cities. It's enough to fund a modest but complete lifestyle. And it arrives whether you're awake or asleep, motivated or burnt out, young or old. This is the threshold where capital stops being something you have and becomes something that works. And once you cross this line, your relationship with money, with work, with risk, with time itself fundamentally transforms. Here's what happens psychologically that almost nobody talks about. You stop living in acquisition mode and enter preservation mode. And these are not variations of the same mindset. They're completely different operating systems. When you're building toward a million, every decision is about accumulation. You're focused on earning more, saving more, investing more. Your brain is constantly calculating, how much closer does this get me? How much further away does that set me back? You're in offensive mode, always pushing forward, always trying to add to the pile. But when you hit 7 figures, something shifts. Suddenly, you're not trying to get wealthy. You're trying to stay wealthy, and that requires completely different thinking. You start noticing risks you never paid attention to before, Market volatility that used to feel abstract now feels personal. A 10% downturn used to mean losing 5,000 or 10,000 painful but recoverable. Now it means losing 100,000. More than most people save in 5 years, gone in a week. Your daily portfolio swings start exceeding what many people earn in a month. You refresh your account and you're up 8,000. You check again 6 hours later and you're down 12,000. These aren't just numbers anymore. This is rent. This is car payments. This is years of contributions evaporating or materializing based on forces completely outside your control. This creates a new form of anxiety that you simply cannot understand until you experience it. When you had 50,000 invested, you checked your account maybe once a week. When you have 1 million, you're checking it daily, maybe hourly, watching your net worth oscillate in real time and feeling your nervous system react to every fluctuation. But here's the paradox. Despite this new anxiety, most people who cross the $1 million threshold report feeling more secure than they've ever felt in their lives. Not because the money eliminates uncertainty, it doesn't, but because it creates a floor, a foundation substantial enough that most catastrophes become manageable rather than existential. Job loss? Still stressful, but you have time to find something good instead of taking the first offer out of panic. Medical emergency? You can handle it without destroying your financial future. Market crash? You have enough cushion to wait it out instead of selling at the bottom. You're not immune to problems, but problems feel different when you're standing on $1 million foundation. Let me show you what this looks like in practice, because the math is where this gets really interesting. Imagine you're living on $60,000 per year, a realistic middle-class existence in most places. If your $1 million is generating $70,000 annually through conservative returns, you're essentially covering your entire lifestyle through passive income. But here's what most people miss. You don't actually need to spend that $70,000. You can reinvest most of it, letting your principal continue growing while withdrawing just enough to supplement your earnings. Let's say you're still working and earning $50,000 from your job. You withdraw $20,000 from your investment returns to cover the gap between your salary and your lifestyle. That leaves $50,000 in returns to reinvest. Your million becomes $1,050,000. Next year, generating the same 7%, you earn $73,500 instead of $70,000. The acceleration has already begun. Keep this pattern going for 10 years, working, earning, supplementing from your investments, but reinvesting most of the growth, and your million becomes $1,800,000. Not because you contributed more aggressively, just because you let the existing capital continue compounding while occasionally skimming the excess. This is the compound acceleration effect. Once you have critical mass, your money grows faster than most people can save. Your investments start doing more heavy lifting than your contributions. The second million comes in half the time the first million took, not because you're working harder, but because you have momentum now. And here's where the identity shift happens that separates people who build lasting wealth from people who just temporarily have money. When you're accumulating your first 100,000, you're a saver, someone who's good at delaying gratification, someone who makes sacrifices. Your identity is built around discipline and future orientation. But when you cross 1 million, you become something different, a capital steward. And these are not the same thing. A saver's job is to accumulate. A steward's job is to protect and allocate. Savers make decisions about whether to buy something or save the money. Stewards make decisions about which investments to enter, which risks to take, how to structure assets for tax efficiency, and legacy planning. This identity shift is profound because it changes every financial decision you make. You're no longer asking, "Can I afford this?" You're asking, "Does this serve my capital strategy?" You're not managing a savings account anymore. You're managing a financial system that has its own momentum and needs. People who fail to make this mental transition often sabotage themselves. They reach 1 million and think, "I've arrived," and start making consumption decisions that someone with $1 million in liquid investments should never make. They buy cars they don't need. They upgrade housing prematurely. They treat the milestone as permission to relax instead of recognizing it as ammunition for what comes next. The people who succeed at this level are the ones who understand they're not managing money anymore. They're managing a machine that produces money. And you don't celebrate a machine by dismantling it, you celebrate by letting it run. Now, let's talk about how work changes when you cross this threshold, because this is where things get psychologically fascinating. You're not financially independent at $1 million. Not in any traditional sense. You still need to work. Your investments can theoretically cover a basic lifestyle, but most people aren't ready to retire on $70,000 per year, especially if they're relatively young and expect decades of inflation ahead. But even though you still need income, everything about how you approach work transforms. When you have nothing saved, you need your job desperately. That desperation shows up in every interaction. How you negotiate salary, how you respond to unreasonable demands, how long you tolerate toxic environments. You accept things you shouldn't accept because walking away feels impossible. When you have $1 million invested, you're still professional, still committed, still excellent at what you do, but there's a different quality to your presence. You're not desperate anymore. You're not operating from fear. You can afford to advocate for yourself. You can afford to say no to projects that don't align with your goals. You can afford to take strategic risks like switching industries or starting something new because the worst case scenario isn't homelessness, it's living modestly off your investments while you figure out your next move. And here's the weird part. This confidence often leads to better career outcomes. People who aren't desperate make better decisions. They negotiate harder. They get promoted more often. They attract better opportunities because they carry themselves like someone who has options. Your posture changes when you have walking away money, and everyone can sense it even if they don't know why. But here's where a lot of people get this wrong, and it's the warning I need you to hear clearly. The first time your portfolio jumps $50,000 in a quarter, or you see it generate more in a month than you used to make working full-time, there's this voice that starts whispering. It says, "You've made it. You deserve something nice. You've been disciplined for so long, it's okay to celebrate." And maybe you start looking at cars, or vacation properties, or lifestyle upgrades that feel justified because you've reached this milestone. You tell yourself it's only 10% of your portfolio. You can afford it. This is the trap, because here's what you're actually doing. You're taking a machine that produces 70,000 annually and breaking off a piece of it. That 100,000 you withdraw to buy something nice, that's not 100,000. That's $7,000 per year in passive income that you just eliminated forever. Over 20 years, that's 140,000 in income you'll never receive. Over 30 years, it's 210,000. You didn't spend 100,000. You spent $250,000 in future income plus whatever appreciation that capital would have generated. The wealthy understand this instinctively. They see every dollar not as present value, but as future income. And they protect that income stream religiously, because once you interrupt compound growth, you're resetting timelines by years. At this level, your goal isn't to spend your wealth. It's to live off the excess while protecting the principal. The million isn't the prize. It's the engine. And you don't celebrate an engine by dismantling it. Let me show you one more angle on this that changes how you think about opportunity cost at this level. When you have $1 million invested, you gain access to things that weren't available before. Not just psychological access, but actual structural access to different classes of opportunities. Real estate investment trusts that require $50,000 minimums suddenly become viable. You can allocate 5% of your portfolio without over-concentrating. Private equity opportunities that require accredited investor status become accessible. Business acquisition loans become easier to obtain because you can show substantial collateral. But here's what's crucial. These opportunities require that you keep your capital intact. Every time you pull money out for consumption, you're not just spending that specific amount, you're closing doors that required having that capital available. That vacation property that seems appealing, it's not just costing you the purchase price. It's costing you the investment opportunities you can no longer access because you reduced your liquid capital below certain thresholds. The wealthy think in terms of opportunity cost constantly, not obsessively, but naturally. Before any major purchase, they ask, what am I giving up by allocating capital this way? And often, once you see the real trade-off, the present desire becomes less compelling. Here's something else that happens at this level that nobody warns you about. Your relationship with other people around money becomes complicated. When you're building toward a million, you're eager to discuss strategies, share wins, learn from people in similar situations. But once you cross seven figures, money conversations become awkward. You can't really complain about investment volatility when your daily swings exceed what most people save in 6 months. You can't discuss the stress of managing assets when most people are struggling to build an emergency fund. Your financial concerns start sounding like luxury problems to everyone who hasn't crossed this threshold. This creates a form of isolation that new millionaires don't expect. The financial issues that dominate most conversations become irrelevant to your situation, while your actual concerns feel inappropriate to voice. You learn to stay quiet about certain things, not because you're ashamed, but because the gap between your financial reality and most people's is large enough that discussing it honestly creates discomfort for everyone involved. And then there's the time dimension that shifts at this level. When you're building your first 100,000, every hour not spent earning feels wasteful. You're constantly calculating opportunity cost. Should I take this vacation or keep working? Is this hobby worth the lost income potential? But when your capital is generating substantial returns, something changes. You realize that your time might be more valuable than your immediate earning capacity. A month of your life spent with family or pursuing something meaningful might be worth more than the salary you'd earned during that period, especially when your investments are growing in the background, regardless of how you spend your days. This is when people start making decisions that look irrational to outside observers. They turn down promotions that would require 60-hour weeks. They take sabbaticals. They pursue projects that don't generate income but provide fulfillment. From the outside, these choices look financially irresponsible. But that's the point. When your baseline needs are covered by passive income, optimization shifts from maximizing earnings to maximizing life satisfaction. And those are completely different objectives. So here's where we are. $1 million invested isn't the finish line. It's not retirement. It's not making it in any absolute sense. But it is the threshold where money stops being something you chase and becomes something that works for you, where capital begins generating income that rivals labor, where your relationship with work, risk, and time fundamentally transforms. Most people will never cross this threshold, not because they can't, but because they don't understand what it requires or what it unlocks. They spend their entire lives earning money, losing it to taxes and expenses, and wondering why they never build momentum. But some people, maybe you will actually get here. You'll spend 15 or 20 years being boring, being disciplined, being patient, while everyone around you is spending everything they make. And one day, you'll check your account and see 7 digits, and everything will shift. You won't feel rich. You'll still have financial stress. You'll still worry about markets and taxes and whether you're making the right decisions, but you'll worry from a position of strength rather than fragility, and that distinction changes everything. 20 years from now, when you're making decisions based on what you want rather than what you need, you'll look back on this moment. The moment when you understood what 1 million actually represents. Not an ending, not permission to relax, but ammunition. A foundation strong enough to build something that lasts. And you'll be grateful. Not because the journey was easy, not because you got lucky or had some special advantage, but because you understood what mattered and you protected it long enough for compound growth to do what it does. You built a machine, and then you let it run. That's the difference. That's always been the difference. And now you know.